Hello and welcome to the Monday call. So, as we reach the halfway point of 2025, I'm joined by Mark Brooks, CIO of NZ Funds, to review a rather volatile year to date and discuss what's in store for us in the second half of 2025. Mark, there is a lot to talk about. I thought we could cover United States shares, New Zealand shares, the economies as well, underlying those shares, positives and negatives of the market. And also, we're going to have to touch some of our alternative assets, namely commodities and cryptocurrencies, given gold and Bitcoin are once again near record highs.
Yep.
We're going to do this in 45 minutes. So we're going to
Gonna have to be
Brees,
succinct.
which is not my middle name by any means, but we'll see how we go. So we were just discussing before we started recording, where should we start? And perhaps rounding things off around where tariffs have got to. We've got the 9th of July, which is a date that I guess people are sort of talking about at the moment.
But generally seem much more relaxed about.
Yeah. So should we kick off in the US, talk about tariffs, and then I guess fly back to New Zealand and touch on that afterwards.
Perfect. Well, I think to do a little bit of a cover ground we've talked about before. Very much our view was that with the tariffs, there was a big change once the administration of Trump said they were willing to pause. We mentioned last time, I think we were on this call, that broadly market downturns come into three broad types. You get either when something is broken, a good example being the GFC, or in New Zealand here with finance companies, where there is a big systemic issue across the economy. They tend to be large drawdowns, more than 25% peak to trough, and long, multi-year events. The other two are an event, COVID, 9/11, and now, we'd see very much tariffs. And the other one, the last one, is really, your sort of garden variety slowdown, similar to what we've seen in New Zealand. And generally, those latter two, they tend to have market drawdowns somewhere in the region of 15 to 25% peak to trough. And very much our view was that certainly post Trump showing he was willing to negotiate, it took that broken economy, broken issue off the table, so the really negative outcome, and pulled us back to either an event or a cyclical slowdown due to tariffs. And that basically at that point, markets had priced in the vast bulk of that. So at that point, we moved back to very much a fully invested position across the growth and actually the inflation portfolios, moved them to fully invested as well. On the view that, the negativity had been priced in, and pleasingly that V-shaped return. And actually this has been, I think on record, the fastest bounce back or recovery back to the starting point for a US share market that's been down more than 15%.
Even faster than COVID.
I think so, yes.
Yeah, because COVID was pretty fast, but in the end, it did take a couple of months.
Yeah, I suppose it was much deeper as well.
Yes,
So
yeah.
time to get back to the recovery. The starting point was longer. But, from that point of view, generally, it's been nice to have been, proved right, I think, from that. And clients have benefited.
Or when you look across the year-to-date numbers and forgetting about that dip, just the year-to-date, and see some really strong performance across countries and sectors. I'm sort of thinking about, Europe, but also sectors within the US and tech.
Yeah.
When we think about some other hiccups that were happening throughout the year, not just related to tariffs, it's been a pretty phenomenal year. And if you went to bed on the 1st of April and wake up at the end of April, you kind of thought it's business as usual almost.
Well, again, it's a good reminder that often you always need to kind of close your eyes to some of these things and step back and say, well, at a very basic level, the questions we're trying to answer are what is happening to growth and what is happening to inflation, because inflation determines where your cash rate is. And that, you just see if cash is at 10%, you can have a very different set of valuations than if cash is at 2%. And likewise, growth determines how economies grow and how businesses' earnings grow. And where earnings go, prices go.
Should we talk about those two things separately? Because I think that's a really interesting way to look at it. And when I think about it, quite obvious, but sometimes we overcomplicate
Well,
things.
the one that is implicit in that is also what does the market expect for both?
Yeah.
So clearly, post tariffs, the expectation was really on the floor, very little expectation for growth, and question marks over inflation.
Because I guess when you think about interest rates and what central banks are doing and all that sort of thing, it's not the level they get to, it's the expectation that we're
As-
gonna go lower or what's gonna happen.
Yeah, and that's very much why. And again, if you think about market psychology, markets are actually pretty good at pricing in what is expected. It's when you get a big change in expectations, like the tariffs, that you get big swings in markets. Uh, and then it becomes that question is that expectation correct now?
So when we think about the inflation part, first of all, sticking to the US, what does it look like when we've got tariffs sort of rolling through, uh, uncertainty in the Middle East about oil prices, albeit, that's certainly not top of mind of investors at the moment anymore. How are we thinking about inflation expectations, which I guess leads to what's the Fed going to do? What's going to happen with interest rates over the course of the next 6 months of 25?
Yeah. Just briefly on oil, a really interesting thesis was a couple of years ago by JP Morgan's asset management, the private bank, some research on effectively the manufacturing intensity of oil. And, certainly for those of us who've, a few grey hairs, everybody sort of thinks back to, yeah, inflation and oil in the 1970s. Relative to then, oil intensity is about 30% of the global manufacturing process. So it's a much less important factor. The other one, obviously, is that the US is self-sufficient in oil. So really don't see that as being um, anything more than a temporary issue. The other one is, there are going to be some inflationary impacts from the tariffs. The question has always been, is it transitory? Will they hit a bit like a GST and then just be a one hit? Or will it be something that is over time and actually a little bit of inflation feeds more inflation? Time will tell, and I think the Fed is taking a pretty wait and see approach. I think it is an interesting, and they certainly don't say this, but I think you can view and take a view that tariffs, they don't want to impose new taxes on US citizens, the administration. Clearly, they want to cut taxes or be seen to be cutting taxes. But tariffs are a way essentially to partially tax the US consumer. A bit like, it's essentially you could think of it as a GST, but some of it's been paid offshore by the supplier and some has been paid domestically by the consumer. And it does seem that there is that mix going on that um, different importers are saying, well, we'll take a chunk of this, and then different exporters are saying, well, we'll take a chunk of it, and ultimately you'll probably see a slightly higher price in the US. So, I think from that point of view, and it does move into also what is the government doing in terms of their spending, and obviously we've had the big beautiful bill in the last couple of days be signed off. The US government's still spending, so that's good for growth, but probably also says you've got a little bit of an inflation impulse in the US. So US interest rates don't seem to be coming down in a hurry. They don't seem to be doing much anyway. Just, they're broadly around 4%, and they're probably going to stay around those levels.
And they've got a double mandate in the US, so they have to look at employment as well. So
Correct.
you could find that, there's some inflation pressures, but at the same time, some job pressures where unemployment goes up, and therefore, the likelihood that they raise rates at least is gone, and so it's more to the downside. So
And I would be of the view that if uh, if you have sustained weakness in the job market, regardless of what inflation is, the Fed would cut rates. Although we saw a relatively, not enormously strong, but a relatively strong monthly non-farm payrolls, which is the unemployment indicator, and actually unemployment slightly fell for June. So it seems again probably leads into some of the other discussion that actually the US is remaining pretty robust from an economic activity standpoint.
Yeah, that's a good segue. So inflation, it's we're not overly concerned by it. That's probably,
Correct. Yeah.
and rates are going to be stable around these levels.
Yeah.
Maybe
Maybe with a
largely.
small, pressure lower, but
Yeah.
yeah.
So then growth, as you said, robust US economy. You know, it's amazing when you look at the charts of GDP growth in the US. It's just been remarkably strong, and then the earnings expectations from Wall Street, i.e., how they do that is they get all the earnings expectations from all the analysts, and there's quite I guess, a heightened expectation of earnings growth of, what was it, 15% or something like that?
13 to 15, yeah.
And
That's
and
really good.
it is,
Yeah.
and there was sort of a non-believers, and it feels like as companies are talking to their shareholders, like, they're kind of delivering on it.
Yeah, so far. Yeah, there will be, I think there will be a slowdown, or at least a temporary slowdown from things like tariffs because it does reduce economic activity. But, for the vast bulk, there's earnings have been strong and they continue to be expected to be strong. And I think that's part of the reason why the market has bounced back so quickly. So you've actually seen positive revisions up in terms of earnings expectations. So that is always a positive. Probably one of the interesting ones has been some of the dynamics between where those earnings have come from. Yeah. For those who, anybody who's been watching markets a lot about last year and certainly early last year and late 23 was all about the Magnificent Seven and tech earnings were dominating. Um, there's still, yeah, those tech companies are still earning a lot of money and have good earnings growth, but the gap between their earnings and the earnings of the wider market had dramatically narrowed, which says that, and you've seen it, that it hasn't been the technology space that's been leading pricey. It's been actually a broader array of companies, and even in that sense, a broader array of countries. And that you've seen places like Europe actually perform pretty well this year, for the simple reason that actually maybe the earnings aren't as high as the US, but actually the gap between their earnings and the US is narrowing. And again, it comes back to that expectation idea.
I mean, market breadth is really important for as investors, because you don't want to get bubbles in certain sectors. And again, and maybe we'll touch on sectors, but when I look at year-to-date performance, I guess there's this temptation to go, it's tech-led, but actually, it's not at all. Tech's done really well year to date,
Yeah.
but when I look at things like industrials, they're the best performing sector.
Yeah, industrials, financials, and interestingly enough, that's quite geographically consistent as well.
Mm.
Yeah, in the US, industrials have been strong, financials have been strong. In Europe, exactly the same case. So, that certainly in Europe, that's a reflection that you're actually seeing better growth, and you've got things like the defence spending they've agreed, and that flows through to industrials.
I think this is where, as an aside, active management is, is super important, because what you want to do is get access to and exposure to some of these sectors that perhaps don't have as big a representation in indices because of what the Magnificent Seven has done in the past. And so doing small things like buying equal weighted S&P 500, looking at shares outside that tech sector is really important. You can generate alpha just by doing that. We haven't even talked about specific company level stuff yet.
Yeah, and even if it's not that, I think importantly from a client perspective, it probably just smooths their outcomes.
Yeah.
If you're massively focused in one sector, say it's tech, you'll have very good returns, and you would have had very good returns for quite a long period of time. But there will come a point in time, just like the New Zealand market's underperforming now, that you get other markets where tide turns. One market underperforms often for an extended period, and if you don't have that diversity, you have very much sort of boom bust type returns.
Is there anything else on the US you think that's worth touching on? I think we've talked a bit on the sectors.
Look, I think probably the one is actually the administration. Is so much of the focus for the first half was on, frankly, probably headwinds from the administration being obviously tariffs, but also cost cutting and Doge, etc. And it would appear now that that was more narrative rather than reality. Let's put it that way, because yeah, in some respects, that is really flipping around. And another reason to be quite optimistic is, yeah, this uh, spending and tax cuts bill is not good for US debt in the medium term or in the long term. But in the short term, there is more spending going on. Yeah, spending is demand. So that will, I think, will aid US activity. And the other one, which has been sort of, I think, under the radar and slightly forgotten about, is there are some quite big regulatory changes going on in the US, mainly to either, say, something like crypto, which we'll get to later, add regulation, which is a positive because it's unregulated. But for some very highly regulated industries like banking, just to wind back the volume a bit and make them slightly less restrictive. And that's one reason why financials as an asset, as a sector, have done really well. Is that for the first time really since the GFC, so for 15 years, the banking sector's been either had more and more regulation or uncertainty about more regulation, which has just kind of restrained activity. And it's meant that yeah, bank lending has grown more slowly than economic activity, which is not what you want. You want a bank, that's one you want banks to be able to lend at least at the speed the economy's grown. And it's a slightly long um, segue into banking, but it does mean that regulatory change actually frees up banks to lend more.
And you're seeing that even in New Zealand as well, with Nicola Willis announcing some,
Correct.
um,
Yeah.
and I guess having some disagreements with Adrian Orr around banking capital requirements and things like that.
Yeah. Yeah. Well, somebody like a good example might be JP Morgan, one of the biggest banks in the US, has excess capital of 50 billion US dollars. Um, they've had excess because they've been uncertain about how much capital they needed. With more certainty around their capital rules, they can actually go and lend that. That's probably another $2 or $3 trillion they could lend, which is good for the American economy.
It's interesting when you think about, though, that big beautiful bill and government debt, and in the US, it seems to have passed even by people that would prefer a smaller government. So, won't get into the politics of that, but they probably quite enjoy being a politician, and therefore, if they don't, they'll be primaried out by Trump. But in reality, when you then move to the UK and see rumor that the chancellor is going to lose her job, and she's quite restrictive on her.
And they've had to step down on some of their welfare cuts.
Yeah,
Yeah.
and so you see yields increase, meaning people want to be given more of a return to buy UK government bonds because they're worried that they're going to be a bit more risky because they worry the spending's going to increase. The market is telling economies, hey, you got to rein in the spending. Your debt levels are too high, and you really got to watch it. And you saw that happen during a speech by a prime minister of a developed country. Is pretty amazing.
Yeah. And I think, yeah, you could, in a similar way, you can sort of say, well, to a degree, tariffs were a similar situation. The speed and the degree of which the US share market fell because of those tariffs, to a degree, had a bit of a, I think if the decline had been 5%, you may have found that the administration would have been slightly more stubborn with their numbers. I think definitely markets have an ability to exert an influence on governments.
We've been working a long time, Mark, and we always go back to, in the end, the bond market will tell you what's happening, and the bond market will tell governments if they've got too much debt and are forced to do something about it. In the US, they don't seem to be too much yet. A little bit.
Yeah, there's a little bit of steepening. So longer term bonds have been going up, where shorter term ones have been coming down. But in the bigger picture, no, they're still relatively. I think the more interesting one to come out of this is, yeah, with tariffs, etc., or actually go back with US exceptionalism in general, is that investors, especially European and probably Asian investors, have been very happy for a number of years to buy US assets unhedged. So essentially take the currency risk. And that's worked really well up until this year. And generally, that's meant that those investors are very long US dollars and very long US assets. they're probably comfortable being long US assets. Going forward, maybe not so comfortable being long US dollars. So from that point, that's been one of the changes out there is that the US dollar generally is down about 10% over the first half of the year.
As we cycle our way towards talking about New Zealand, should we talk about currency? It's something that we do a lot of work on, but don't often talk about. I'm throwing this at you
Yeah, yeah.
without giving you a heads up, but it is sort of your forte in some ways. Do you just have a view of what's going on in those currency market? You've touched on the US dollar. Is essentially that theme is we've got a US dollar weakening, and that's, I guess, causing pressures depending on how you hold your assets and what your positioning is for other investors outside the US.
Yeah, well, again, if you come back to relatively, we'll try and keep it simple, is yeah, if you have a US has a large trade deficit, if you're buying more products than you're selling, that by definition means you need to sell US dollars to buy those products. So it puts some downward pressure on your currency. Uh, and in the case of New Zealand, that generally means that the currency moves lower when the current account deficit widens. Uh, in the US's case, trade has been negative, but everybody's wanted to buy the financial assets. So it's really had that balancing factor, and probably over and above, there's been more people buying financial assets than there have been buying, on the trade side. If that, because of the weight of investment in the US, if people maybe they don't sell US assets, but they look to hedge and cover their US assets and convert them back into their home currency, it just means that the US actually, has to be more attractive to attract more money in. So probably puts pressure on the dollar as it would theoretically to move a bit lower. So, we've seen a long period, multi-year period where the US dollar has been getting stronger and stronger and stronger. And much of that's been because of US assets have been in favor. And as a result, US is, on a simple purchasing power parity, Big Mac type idea is relatively expensive. Currencies like Japanese yen at the other extreme are very undervalued, very cheap, that you would expect more of a rebalancing back to those currency markets. Yeah, rebalance over many years, in fact, even decades at times, but you would expect the pressure swings back a bit.
And the consumer knows this even if they don't really look at it, because all of a sudden there's a lot of foreigners skiing in Japan and a lot less
Yeah,
going to the US.
exactly. Exactly.
And that might start flicking around as US dollar weakens. Should we touch on New Zealand? So, in my journey around the country talking to accountants, you've got, and we've touched on this before.
Yin and yang type response.
Totally, yeah, and it's all geographically dependent in terms of who's positive and who's negative. So down in the south, all the way up to top of the South Island, pretty positive, driven by agriculture, farming, um, predominantly dairy, but also sheep and beef prices have also been strong. And with it is getting a bit stronger, but at the start of the year, sort of weaker dollar, that's been great for export. Wellington's really difficult, and for obvious reasons around government cuts, and then the rest of the country's kind of been driven by house prices, and therefore you've got this catalyst of lower interest rates slowly feeding through to the market. But then you've got this wall of recovery, and we've touched on this call before. But how is that theme going, and are you seeing that sort of flow through into share prices, or what are our expectations of that?
Yeah, well, I think, look, mea culpa, I've been excited about the New Zealand opportunity and and that have definitely been too early because the economic recovery is, as you touched on, very slow in general.
But you're seeing it in GDP though. That's the weird thing, a little bit.
Yeah, yeah. And that's been one of the challenges is you're seeing a lot of conflicting data and probably that's where you see at the tuning points, right?
Yep.
But yeah, that GDP number of 0.8 was perfectly fine. Yeah, that is what we had during the days when the New Zealand economy was that sort of global rock star in the 2010s, we were doing point eights, but we were doing point eights consecutively
Mm.
each quarter. So we've got to continue that. I think, as I said, the data has been conflicted. There's certainly some sectors, construction, residential and commercial construction, which are still in the deep doldrums and probably can't see a light at the end of the tunnel. The other side, you've got agriculture, which is booming. Um, I think, yeah, you are seeing recovery. It's just happening probably much slower than the urban economy would like. I think there's a couple of factors for that. One, you've probably got a bit of a J curve. To use some economics terms, a J curve happening where, you know, the savers who are getting paid high interest rates see the negative impact of that quicker than the borrowers who are on fixed rates. So essentially, as interest rates move down, the immediate effect's actually negative rather than positive. I think we've had some of that for urban New Zealand. Two, you touched on housing. I think, whether we like it or not, housing's a big part of people's psyche. It's about the big part of their wealth, perception of how wealthy they are and where they're willing to spend. So I think, because of the housing market being moving sideways, that's really probably constrained activity. But if we look around different indicators, there's certainly some that are confusing, and things like the purchasing managers index and the services index, they were above 50, which is a sign of expansion. They've fallen back and fairly significantly back below 50, which suggests you've got a bit of an air pocket going on. But otherwise you are seeing positive results. The other surveys suggest quite good growth is coming. We had the QSBO, which is the NZIER quarterly survey of business opinion, and that's New Zealand's longest running survey back to the 1970s. And that's still quite strong. That suggests actually we're probably headed towards a 3% type GDP number, which is, well away from what most people are expecting. Are you seeing it, some of the partials? We saw motor vehicles today, maybe because of the government's investment boost, depreciation initiatives. New vehicle sales were up, seeing a slight improvement in things like delinquencies. So just, small, but it seems to be happening. I think the other one is, again, from a mortgage holder's perspective, that's still taking time. The average mortgage rate average effective mortgage rate, according to the RBNZ, still 6%. So it's really going to probably come down 40 basis points. There's a lot more to come down. At the same time, I think there is an argument. I'm a little surprised the economists of the different banks are not pushing harder, is that actually, the Reserve Bank was very restrictive, had their foot on the brake. They made a lot of discussion about wanting to get back to neutral, an area, a point where interest rates aren't impacting the economy forward or back. But we're now back at sort of 325 is within what they consider the neutral band. You probably need to be at the bottom of that band, or actually arguably probably tapping the accelerator a bit. That would seem, and to me, that would be somewhere in the low 2% region, sort of from 325 down to 225, I think would be just enough to start to give that, give the economy a bit of acceleration. I think the other one that people focus on, which I think personally is a bit of red herring, is there is this concern that inflation's going to spike back up. I think there are definitely some reasons, lots of talk about food prices at the moment. Some reasons why sort of headline CPI probably does move back up towards 3% in the short term. But food prices move around all over the place. Oil's not going anywhere.
And our dollar's getting stronger anyway. So that
exactly. Domestic energy costs have been high, but some of that is actually the fact that we had a very dry summer and prior winter. All it's done in New Zealand's rain for the last 2 months. We've got lots of water and hydro lakes are filling up rapidly. Surprise, surprise, the wholesale electricity price has fallen dramatically, so it doesn't seem you've got an impulse there. And then the last one is that people forget about, housing. Housing's 30% of CPI. That's doing zip. the moment. In fact, if anything, rental inflation is arguably going to go negative at the margin.
It's how much is this coming down to a personnel issue when we've got an acting Reserve Bank governor who doesn't really want to, things are going okay at these levels and doesn't want to rock the boat until he either gets the job or someone gets the job.
Yeah. Yeah, that would, I don't know, but I think definitely that's, you could say that you'd be tentative to be making, trying to really push the boat out.
He's not going to drop at 50 basis points next week or whenever the next earnings.
Right.
Yeah, right, yeah.
Yeah. Good on him if he does. Yeah.
Yeah.
Let's go.
Why don't we move on to now commodities and crypto? I think you mentioned regulation and digital assets and cryptocurrencies. It's not a negative; it's a real positive.
Yeah.
And it's something that we are really happy to see.
Well, I think it's a question of where is the regulatory pendulum. Banking pendulum's gone too far. It's too restrictive. Crypto, I think everybody would happily argue, needed some regulation to actually be
Mm.
positive.
And so, I don't know how much you want to delve into the actual what they've done, um, in terms of from the US regulatory point of view, and what we're going to do on this call is get some regulatory experts in to talk about it. But I guess the theme around regulation is it just leads to more institutional uptake, doesn't it? If every portfolio in the world had 1% of cryptocurrency in their portfolios, the price would be $1 million or something. Don't quote me on that.
Look, I think we've been positive crypto for a long time. Very much last year, we separated Bitcoin out, probably more formally in the sense of our discussions that being, kind of view crypto as a commodity, and a commodity is about demand and supply. And it was very clear that Bitcoin had a natural demand supply imbalance. And really it was gold, and it was a digital gold and was increasingly being adopted as that. So there was a natural demand which outstripped the supply. So expected price to move higher. In terms of the other crypto sector, or cryptocurrencies, and specifically things like Ethereum, probably the next largest, it's not a store of wealth like Bitcoin. So it's a question of where is it used, what creates that demand versus the supply. And in another way, it's a bit like a technology adoption cycle. How much are people using it? And in many respects, it always seemed to be a solution looking for, a technology looking for a solution to solve. Didn't quite have the use case. This is where regulation comes in that stable coins, which increasingly have been used outside, we actually say outside of the developed world, so areas where people either don't have a bank account or where they have a domestic currency which is all over the place and not very stable, can buy something like Tether, the main stable coin. They can buy it on their phone in a wallet, and it gives them an asset which is stable. They can put savings into. They can transact through it in a way which, you don't have the faith if your currency's all over the place. So that's been, there's $160 billion or so in Tether of assets. The regulation in the US is basically bringing those stable coins into a US regulatory process. So similar as you would a cash fund in the US, that it needs to be audited, it can only hold certain sorts of assets, it needs to be transparent, it's regulated by certain regulators. And that just sets this tone for probably blockchain to actually finally get a use case. And you're seeing in our industry, in the financial industry, quite a lot of work's being done in areas like, it's really the boring plumbing, settlements. How do they settle share transactions, things like that, which blockchain probably can do vastly quicker, more effective, with less friction, and with ultimately more trust as to what's been there.
I think that's a really good point. I think it's amazing that not everybody's celebrating, but there was this big push to put share markets to a T+1 settlement. So it takes a day to settle a share transaction, and in crypto, you can settle it in minutes,
Yeah.
seconds even.
Yeah.
Oh, it's so far and away the most efficient form of technology for those sorts of transactions that fast forward 10 years, it's all gonna be down to blockchain. It's just an absolute no-brainer.
And that's why I refer to it as plumbing. You won't see it necessarily, but do you know what your Visa transaction, how many hands that goes through at the moment? Yeah, and the fact that Visa actually has no risk to your transaction. All they do is approve that the card is actually valid. A lot of that will run probably on a Solana chain because it's very fast and it effectively instantaneously verified. But that plumbing will be really important.
I mean, imagine if, and this is why we like Solana, if, a whole chunk of Visa transactions are now settled through the Solana blockchain. I mean, that's trillions of transactions
Yeah.
a day.
Yeah, exactly.
So regulation being a
So I think, things like that, it's actually becomes a bit of a positive for the US economy. Yeah. Some of the, there's, I suppose, regulation is no longer holding back the crypto industry to the way it was, and it's actually freeing up more traditional areas like banking, all of which are probably good for growth.
And then I think when there's a lot of media, I guess, focuses on the less utilization aspects of crypto, like meme coins, which are sort of a joke and unregulated and dangerous and just not really adding any value.
Correct.
But don't let that get in the way of thinking about these aspects of crypto, which is why we're invested in the ones that
Yeah.
we are.
And back to Bitcoin, you just see sort of growing demand. It's not going to be a solution for things like Visa, etc. It's too slow. Doesn't work like that, but continues to be a way to kind of diversify into a stable asset, just like gold. It's probably a good segue to gold. Gold, probably two of the better performers this year are being gold, as it was last year, and Bitcoin, as it were last year.
Yeah, gold again. It's been a great asset class, but you still have to store gold. We had a client who uh, you know was was of older age and passed away and had a whole lot of gold bars stored, and their family now has to work out how you get
What
rid
do you do
of,
with it?
or what do
Yeah.
you do with a gold bar if that store of value is in Bitcoin, it will take half a day.
Yeah.
Um,
Yeah.
Not even that to sort of you know, have the family be able to sort of distribute it, keep it secure, and then work out what to do with it, as per the wishes of the client. But it's just such a no-brainer again, because gold's inherent value is not actually that high. It's all around store of value.
Yeah. And again, as I said before, our approach with commodities is always about where is the demand supply and balance or balance. And for gold or for Bitcoin, it's about the fact that demand is growing and it's a very small supply, and gold's exactly the same. It's just you probably had a structural change over the last couple of years as to who the buyers of gold are. Um, and if we go right back to when the US left the gold standard, and at that point, sort of, I suppose Americans couldn't own gold, but gold became more freely traded in terms of its value. It
So Americans couldn't own gold.
They were
Oh, I didn't know that.
just promoting gold
Really?
for a
After
period.
after they left the gold standard, I
Yeah.
was like, oh, I did not know that. Interesting.
Uh,
I guess that's why in '87, all those New Zealand companies that could own gold, because there was a lack of Americans owning it. Anyway, sorry, we digress.
just for that sort of period in the 70s and early 80s was really gold became a inflation hedge, and it did actually follow the path. Its value followed the path of inflation, and much of that reflected probably how people purchased it, which was basically was retail purchases in gold bars. So if inflation was up, people bought gold. Move forward to the 2000s, and basically gold became more financially tradable through things like futures. yeah, you brought it into more of a professional investor framework. And in that sense, they thought not so much about inflation, but where are real interest rates? Where are interest rates after inflation? And yeah, if interest rates are high, if real interest rates are high, there's a big cost to owning gold because doesn't pay you anything. When real interest rates fall, you become happier to own gold. So there was a very close relationship between those two. And then third part is really the Ukraine war, and that yeah, all of a sudden you had Russia's external reserves were frozen, and increasingly countries said, well, what is a currency, a reserve currency I can buy that is not controlled, that is transportable, and gold is the easiest to, is the top of that list. So yeah, countries' reserves that they have for managing essentially their currencies, etc., generally have very low holdings of gold outside the US and UK and a few others. So even small percentage changes, gold is a pretty small market. Small percentage ownership changes from central banks around the world create a very large demand. And that's really what you've seen. And it's a big reason for the last 2 years that gold's been top of the performance range is that central banks have been buying. They're buying about a third of all production now. And they're relatively price insensitive.
They just need to buy it.
Yeah, and I think that's going to continue for a while yet.
Systematically buying.
Yep.
Gordon Brown must be a bit disappointed. He sold a whole lot at $900 an ounce.
It's a little higher than that now. Yeah.
Was it 3,300? It's still a position in the portfolio and something we just like that.
Yeah, look, we think, has diversification benefits for us. And within the growth space, clearly shares are the key part of that. But, especially with our global macro portfolio, we want to have assets that can have similar return profiles at different points to shares, but are not shares. So that's certainly where gold and crypto come in.
So I've gone through US shares, remain positive. Our outlook is strong. New Zealand touch early, but we're really positive about the outlook as economic green shoots start floating through. And I think these turning points, like you say, are difficult, but we think it does happen. It's just the nature of economic cycles.
Yeah.
And then those alternative assets at the same time provide a return that's separate from those asset classes, but still equity-like returns, but perhaps with a lower correlation.
Yeah. Just provide that diversity, which is what you want.
Well, I think that's been a really good summary of where we've been, Mark, and that I guess the volatility of markets in April, I guess, can be relatively unsettling, but actually our outlook is positive, and I'm guessing we will probably see some more volatility through the year ahead.
Yeah, without a doubt.
But that just provides opportunity to think a longer term if we want to be invested in these shares. It gives us some good entry points.
Yeah, look, as I said before, it's about trying to always come back to the points and say, well, where do we think growth is, both at an economic and a company level, and what's happening to inflation? And if inflation is not out of control, is not moving higher, then that generally means cash and fixed interest assets are stable, or yields are falling, which is generally positive for markets. And if there is growth, that's good. Share prices follow growth. So it's about making that decision. And at the moment, we think New Zealand's hopefully going to grow more, and the US and Europe, etc., growth is there and probably better than people expect.
What a great place to stop. Thanks very much for your insights, and thanks everybody. Look forward to speaking in a couple of weeks. Until then, have a great rest of your week. Cheers.
New Zealand Funds Management Limited is the issuer of the NZ Funds Active Income Series, NZ Funds Active Inflation Series and NZ Funds Active Growth Series, together the NZ Funds Active Series, as well as the NZ Funds KiwiSaver Scheme, the NZ Funds Managed Superannuation Service, NZ Funds Wealth Builder and NZ Funds Income Generator. For further information or to request a copy of the product disclosure statement for each of these, please contact NZ Funds or visit nzfunds.co.nz. This recording is provided for information purposes only. The information provided is not intended as a substitute for specific professional advice on investments, financial planning, or any other matter. Past performance is not an indication of future returns.